Good morning. We begin with economic value added. Before we start with economic value added, let us understand certain concepts behind this economic value added. Okay, what is this economic value added? Of course, we know the income statement, how to prepare the income statement of the company. We work out income less expenses, which may be direct expenses or indirect expenses, like cost of goods sold and operating cost we reduce. We get EBIT. It is also known as operating profit. Okay, less interest. Okay, like that we work out. Okay, so how do we get operating profit? Simple. Operating minus operating expenses will give us operating profit. Operating income minus operating expenses will give us operating profit. How to work out operating income? Simple. Take all income from operations less cost of goods sold will give us gross profit, right? Less operating expenses. What do you mean by operating expenses? Administration, selling and distribution expenses. It will give us operating profit. Wherever there is a profit, you have to pay taxes. Okay, so less taxes. It will give us operating profit after taxes. Okay, for this income statement, I don't consider non-operating items because non-operating items are temporary in nature, and there is no guarantee that you will earn that non-operating income, like income from investments or profit on sale of assets or abnormal items like that, or some one-time incomes, all those things. So we consider only an operating. It's a kind of an operating profit statement. So this is a kind of operating profit. Okay, so this operating profit is otherwise called as EBIT minus taxes. EBIT minus taxes, we get okay NOPAT. This is called as net operating profit after taxes. NOPAT. Maybe you can use the word net operating profit after taxes. Okay, so it's a kind of a revised income statement that I prepare. Only one thing is, I'm not considering non-operating items. I'm not considering non-operating items. I consider only operating items. I told you already, non-operating items, we are doing valuation. We are not doing accounting. We are doing valuation. Non-operating items, okay, it may occur or it may not occur, or it is not from business. It is from other sources. So it may come, it may not come. It may be a one-time income, or it may be a regular income kind of a thing. So this is how we work out net operating profit after taxes. Okay, so this profit after tax is earned. Okay, with this profit after tax, what you have to do? This profit 100% goes to equity shareholders? No, you have to bear the cost of funds. We don't use 100% equity. We use equity, we use preference shares, we use reserves, and we use what? Borrowed funds also. So net operating profit after taxes less weighted average cost of capital, or otherwise called as KO. You would have learnt in cost of capital chapter. So NOPAT less weighted average cost of capital will give us, for example, let us assume your operating profits are like 30 lakhs or 3 crores. Okay, and your cost of capital is like 20 lakhs. Okay, so the surplus 10 lakhs goes to whom? Please remember, it is not cost of equity or cost of preference shares or cost of borrowed funds. It is overall cost of capital. This surplus of 10 lakhs goes to whom? Goes to the shareholders. So this is called as EVA. This is called as EVA. So what is EVA? The surplus profit after bearing the cost of funds. Otherwise, this 30 lakhs is like return on capital employed. This is the cost of capital. This is what we get. 30 lakhs is what we get, and 20 lakhs is the expectation or cost of overall cost of capital or total cost of funds employed. So the surplus money earned increases the value of shareholders. So hope you understood now this economic value added. Economic value added is nothing but the surplus profit or surplus economic value created for your shareholders. Okay. Because ultimately, for example, when you borrow money at 10%, when you are earning 15%, the surplus goes to equity shareholders. Same way, if cost of preference shares are 12%, and if you are earning 15%, the surplus automatically goes to equity shareholders. Okay, and if equity shareholders are expectations are 14%, if you are earning 15% on your funds invested, okay, the surplus 1% goes to equity shareholders only, because any surplus or any deficit should be borne by whom? Equity shareholders. They are the ultimate risk bearers. So they enjoy the fruits as well as they enjoy the pain. Okay. So this is called as economic value added. Otherwise, the surplus earnings created over what? Weighted average cost of capital. So how to work out EVA, sir? There are two approaches. EVA, simple. The first approach is what we discussed now. NOPAT minus weighted average cost of capital. This is the first approach. Or return on capital employed minus return on capital employed minus cost of capital this multiplied by capital invested. It's an alternative approach. Okay, return on capital employed, how to calculate? Simple. How to calculate? NOPAT divided by capital employed. Here normally we take closing capital employed, not like goodwill valuation. We normally take what? Closing capital employed into 100. This will give us return on capital employed. Okay, what is cost of capital? Nothing but weighted average cost of capital, otherwise called as overall cost of capital. Okay, there are two methods we can solve. So how to work out EVA? What is the first approach? Net operating profit after taxes minus weighted average cost of capital, otherwise known as overall cost of capital, or work out return on capital employed in percentage, take the cost of capital percentage into capital invested. Okay, so that is called as economic value added. The surplus money goes to shareholders. So this is the crux or concept behind it. So you should have a knowledge about the cost of capital or the chapter cost of capital, okay, to solve the problems for examination point of view. Probably let me to take a small problem and work out. But before that, I request you to pause this lecture and copy this notes. So economic value added is the surplus earnings that goes to equity shareholders. Otherwise, it is excess over the cost of capital. Operating profit in excess of cost of capital. How to work out? This is the thing. Income from operation minus cost of goods sold, gross profit minus operating expenses. Cash and non-cash expenses also we will take it. We get operating profit, otherwise called as EBIT, minus taxes, we get NOPAT. Minus weighted average cost of capital, we get EVA. That's what is the first approach. NOPAT minus weighted average cost of capital gives us which one? Economic value added, or return on capital employed minus cost of capital into capital invested. How to work out return on capital employed? NOPAT divided by capital employed into 100. Cost of capital is nothing but weighted average cost of capital, okay, or overall cost of capital. I will apply both the methods and solve a problem for your understanding. Let us take a simple problem. Capital employed in a company is, let us assume 50 lakhs less, okay, let us assume the company has made an EBIT or otherwise operating profit of let us assume 20 lakhs. Okay. It has a tax obligation of 40%. Its overall cost of capital, weighted average cost of capital, otherwise called as overall cost of capital, is let us assume 15%. Okay. Now, how to work out EVA? What is the first approach? NOPAT less weighted average cost of capital. So, let us try in this approach and let us go for the other approach also. For this, we want NOPAT. What is NOPAT? EBIT, that is operating profit, 20 lakhs less tax. This into 40%. We get EB, that is, this is called as NOPAT, 12 lakhs. Right? So, this is NOPAT minus weighted average cost of capital. What is weighted average cost of capital? Capital employed is 50 lakhs into what is overall cost of capital? 15%. So, our profit earned is this much, 12 lakhs. Weighted average cost of capital is 7,50,000. The surplus is known as EVA. EVA is the difference between NOPAT minus weighted average cost of capital. Otherwise, expectation of the funds provided is 7,50,000. NOPAT is like 12 lakhs. We made a surplus of 4,50,000. This surplus is enjoyed by equity shareholders. Okay. And when there is a positive EVA, okay, the value of the company will be more. Market value of the company will be more than the book value. Done. This is a small concept behind EVA. Okay. What is the alternative approach? Return on capital employed minus cost of capital, otherwise called as weighted average cost of capital, into capital employed. Okay. How to work out return on capital employed? NOPAT divided by capital employed will have the same meaning. Okay, long term funds, total of long term funds, okay, into 100. So, this is NOPAT. So, when you apply this, NOPAT is this much, 12 lakhs divided by capital employed 15 lakhs into 100, 50 lakhs into 100. We get 24%. So, now we can work out EVA is equal to 24% minus 24% minus what is the weighted average cost of capital? 15% into capital employed. You get the same 4,50,000. Okay. Return on capital employed is 24%. Cost of capital is 15%. So, difference is 9%. We make 9% surplus. So, 50 lakhs into 9%, you get how much? 4,50,000. Okay, this is called as what? Economic value added. So, first I am going with your study material problems, then let us come to our material. Study material problems, only 2 or 3 problems are given and they are simple. Go to this problem. Okay, we can open the study material and go through this particular problem. Search for economic value added and you can go through, otherwise you can just see the screen and do it. It is easily understandable. Equity share capital 5 lakhs, preference share capital 2 lakhs, reserves and surplus 6 lakhs, non-trade investments rate of interest is 10%, okay, 20% debentures are given, profits before taxes are given, okay, tax rate is 40%, WACC is 13%. Okay. So, what is the total of long term funds employed? 5 lakhs plus 2 lakhs plus 6 lakhs plus 3 lakhs, 5 to 6 plus 3. This is the total of long term funds invested. Okay. And the profit before tax is given to us. Profit before tax is given to us. It is not EBIT, it is profit before tax, which means after deducting interest, what is the profit before tax is given to us? Tax rate is 40%. Okay. So, weighted average cost of capital is 13%. I hope they have gone by the second approach. Okay, return on capital, operating capital is nothing but return on capital employed minus weighted average cost of capital into operating capital means capital employed. So we have to first find out the operating profit. What is the profit before tax is given? 2 lakhs. We want EBIT. How to work out EBIT? Add back interest, because this profit after tax is calculated after deducting interest. We want EBIT. So 3 lakhs into 20%. 3 lakhs into 20%, it gives us how much? 60,000. And eliminate non-operating income. I told you in the introduction itself, non-operating incomes are not to be considered for EVA purpose. So eliminate non-operating income, we get operating EBIT. Okay, this is called as net operating profit before taxes. Okay, minus tax will give us NOPAT. Minus tax will give us net operating profit after taxes. Right? Profit before tax, add back interest minus non-operating income, we get EBIT, minus taxes, you get NOPAT. Okay. So then how to find out capital? I told you all the long-term funds, equity share capital plus reserves and surplus plus preference share capital plus debentures, total long-term funds. We know while doing goodwill valuation, we will not consider what? Non-operating assets like non-trade investments. When you go with assets minus liabilities route, we will work out what? Total assets excluding non-trade investments, okay, and non-current liabilities will reduce. When you take a liability route, how to do it? Simple. Maybe you would have seen in this ratio analysis also. Share capital plus reserves and surplus plus long-term debt minus non-trade investments. This is a liability route of working out capital employed. Maybe in intermediate level you would have learned this ratio analysis chapter, this capital employed. Share capital plus reserves plus long-term debt minus non-trade investments will give us what? Capital employed. So what is the capital employed? 15 lakhs. Capital employed is 15 lakhs. So NOPAT is 1,50,000. Capital employed is 15 lakhs. So when you work out return on capital employed, 1,50,000 divided by 15 lakhs into 100, you get 10%. Clear? Which means the company is earning 10% on the capital employed, on the operating capital employed. After paying taxes, you are making what? 10%. But what is your cost of capital? 13% is cost of capital, which means the company will have a negative value added. So EVA is nothing but this one, return on capital employed minus weighted average cost of capital into operating capital or capital employed, you get negative EVA. The EVA is negative, which means the company is not able to earn adequate return for the funds employed, because expectation of the funds provided is 13%. The company makes only what? 10%. You are earning only 10%, but their expectation is 13%. Obviously, you will have a negative value. So when the company is doing like this, you will find the share market value will come down, or the market value will come down. Sir, the company has a profit. Yes, profit, but it is not making adequate profit. So the this one will come down. Market price of the share will come down. Now we can work out by alternative method also. What is the alternative method? NOPAT minus weighted average cost of capital. What is NOPAT? 15 lakhs. What is weighted average cost of capital? Sorry, NOPAT is 1,50,000. Sorry. What is weighted average cost of capital? 15 lakhs into 13%. You will get 15,45,000 is the cost of capital. So when you reduce it, EVA becomes negative value. You are not able to earn adequate return for the funds employed. So for examination point of view, how to work out EVA? Simple. Work out NOPAT minus weighted average cost of capital, you will get what? EVA. Go to this illustration. We are given sales information and pre-tax accounting profit is given, tax is given, profit after tax is given, dividends are given, retained earnings are given to us. Fixed assets, net current assets means current assets minus current liability. So, fixed assets, this is like working capital. You know, in financial management, you should have learned this. What is gross current asset? Current asset. What is net current asset? Current asset minus current liability, otherwise working capital. So, this is like capital employed. This includes equity shareholders funds and long term bank loan like that. Okay. The company's performance has increased. Preference shareholders are not satisfied for the past 2 years. You are required to calculate EVA. Okay, we are given pre-tax cost of debt. Pre-tax cost of debt 9% and 10%. Cost of equity is 15% and 17%. Tax rate is given to us and interest expense is given to us. Okay. So, before in this problem, we are not given weighted average cost of capital. We are not given weighted average cost of capital. So, before we proceed with this problem, let us go to the concepts like cost of capital, how to work out cost of equity, cost of debt, just browse through. Okay. These things you have done already in the intermediate level. I am just going to recollect the cost of capital chapter. Shall we? The cost of capital, of course, we denote it with symbol K. Of course, these are the long term sources that we employ. We use KE, KR, KP and KD. This is not new to you. Of course, cost of debt is nothing but I into 1 minus T. Interest is saving, that is tax, interest is saving the tax. So, I into 1 minus T. I means interest rate, 1 minus T means the tax rate. Okay, if you do not have the notes or if you forgot what you learned in intermediate level, please copy it. Not now, at the end. The debt may be redeemable or irredeemable. What is redeemable debt? It is redeemable after some time. Okay. For redeemable debt, how to work out? IE plus, I means interest plus redeemable value minus issue proceeds. Redeemable value means the price that you are going to repay. Okay, the price at which it is going to be redeemed. IP means issue proceeds, the net proceeds of issue, divided by N, number of years, divided by RV plus IP by 2. And some authors take this I into 1 minus T here. I into 1 minus T, they take it here, then they take RV minus IP by life. But according to me, both interest as well as the issue expenses can be amortized or can be claimed as an expense for tax purpose. So, I give tax benefit for both. But some authors give tax benefit only for interest. I give tax benefit for both, because you can write off share issue expenses, underwriting commission, brokerage and all. So, both direct cost and indirect cost as a tax benefit, you can do this. So, divided by average value. If it is redeemable, if it is irredeemable, interest divided by issue proceeds into I minus T, 1 minus T. Interest means the interest payable. Issue proceeds means simple face value minus issue expenses like underwriting cost or brokerages or flotation cost. You call it as flotation cost. Okay. So, this is how we work out cost of debt. Okay. Then how to work out cost of preference shares? This also can be redeemable or irredeemable. Simple. Only difference is preference dividend is not saving any tax. Preference dividend plus RV minus IP by life divided by RV plus IP by 2. If there is a corporate dividend tax, there is an additional burden which you will add it with preference dividend. So, this preference dividend will include corporate dividend tax also if there is any, because year to year the income tax provisions changes. Last year they said corporate dividend tax is there. This year they say the corporate dividend tax will not be there. So, depending upon the situation or the tax situations, the corporate dividend tax will be added. Okay, so the preference dividend includes what? All the cost, distribution cost also, corporate dividend tax also. So, RV means redeemable value of preference shares. Is it going to be face value with premium like that? Okay, IP means same, face value minus issue cost like underwriting commission, brokerages, all those things. Life means number of years for which it is issued, N. Okay, so if it is redeemable, we use that formula. If it is irredeemable, dividend divided by issue proceeds into 100. Okay, this is for preference shares. Okay, so equity, there are different approaches with which we can work out. Dividend by market price into 100 or dividend by market price into 100 plus growth rate. We call it as D1 by P naught into 100 plus G. You would have learnt it in corporate, there is a business finance or financial management. D1 divided by P naught into 100 plus growth rate, or it can be EPS by market price into 100. EPS, of course, earnings per share divided by market price into 100, like that we can work out. Then, what is cost of reserves? Reserves belongs to equity shareholders. So, cost of reserves is equal to cost of equity. Okay. RV means redeemable value, IP means issue proceeds, I means interest rate, T means tax rate, PD means preference dividend including corporate dividend tax, G refers to growth rate. Okay. So, this dividend means dividend expected for the current year. Dividend expected for the current year should be taken. So, if you remember this, no issues, otherwise I request you to copy this. Okay, I will just go the other side. Just pause and copy. I hope this is not all right. Just pause and copy this. Just pause the lecture and copy it. This is cost of capital. Right? Your knowledge of cost of capital is definitely required for solving the problems. Hope you copied. I am proceeding. The cost of equity can be worked out using another model called as capital asset pricing model, because it is the expectation of shareholders. Of course, we know when you don't take any risk, you will get only risk-free rate of return. Okay, RF refers to risk-free rate of return. When you take a risk and go to the share market, there is a market rate of return. Okay. For example, when you do not want to take any risk, open a PF and deposit, or go for a good bank and deposit in FD. Okay. So, don't just buy a government security, you may get 5%, 6% like that. If you go to the share market, you may get about 10 to 12%, but you are taking risk. Okay, that's why you are expecting more than that 6%. When you take risk, your expectation will be more. Okay, so risk premium is nothing but market rate of return minus risk-free rate of return. Okay, certain risks can be diversified, certain risks cannot be diversified. Okay, diversify means simple, by holding multiple shares or different company shares, by distributing your investments, you can diversify. Certain risks cannot be diversified. All these things you would have learnt at the intermediate level, because I am just browsing through. The capital asset model works like this. This also you would have learnt, but still, okay, maybe you can copy this first. RM refers to market rate of return, RF refers to risk-free rate of return, RM minus of RF is otherwise called as risk premium. That means the extra return that you expect for the risk that is taken. So, capital asset model works like this. Okay, let us take this particular thing. Let us assume this is how it swings. It can be BSE or NSE index. Like you would have learnt. I mean, you would have seen in the news channels. BSE index, increased by 100 points, down by 100 points. And during the corona time, you can find it reduced by 2000 points, 5000 points, okay, 10,000 points, like that it went down because of the corona effect. Panic selling took place. So many things you would have learnt, right? So, this is how, let us assume, the index moves. What is an index? It is an average of share prices purchased and sold. Listed company share prices purchased and sold. It can be BSE or NSE. It represents the average value of shares bought and sold. If it goes up, prices are going up. If it goes down, prices are going down. Let us assume there is a company called A Limited. The A Limited price is moving. How it is moving? Along with the index. If the index moves up by 2%, the company also will move up by 2%. If the index falls by 20%, A Limited share price also will fall by 20%. It moves along with the market. Okay. So, the risk will be equal to market risk. A Limited risk will be equal to market risk. and there is a company called B Limited. This also moves, but not moves like A Limited. There is a movement, but not like A Limited. The volatility, okay, the fluctuation is not exactly equal to market. There is a lesser volatility. So compared to A Limited, B Limited will be more risky or less risky? B Limited will be less risky, lesser volatility, lesser fluctuations, less risky. Okay, and there is a company called as C Limited, and this company does not move at all, stable. Whether the share price go up or let the share price come down, C Limited price is stable. C Limited price is stable, flat, no risk. It's like a government security. Whether government security will give you more return when the market increases? No. Will it reduce return when the market reduces? No. So C Limited is like a no risk company, zero risk company. And look at this company. It reacts much higher. D Limited is a high volatile company. So which means risk will be more. Risk will be more. So the risk is measured by a factor called as beta factor. The risk is measured by a factor called as beta factor. Okay. So for A Limited, we can say risk is equal, beta factor is equal to 1. Beta factor is equal to 1 because it moves along with the market. B Limited less than 1 because it is not moving equal to market. It is moving but not equal to market. C Limited no movement at all, which means beta is equal to 0. D Limited beta will be more than 1. It may be 2 or 3. Okay. So A Limited equal to market risk. B Limited less than the market risk. C Limited no risk. D Limited high volatility, high risk. Okay, so based on this particular risk and return, based on the volatility of shares, when expectation or ERR is determined, that is called as capital asset pricing model. So how to determine the volatility factor? It depends upon correlation. It depends upon correlation, standard deviation, all those things. That knowledge is not required for you. Only when you are a stock analyst, that particular thing is required. Otherwise, it is not required. So I request you to copy this. So just note, A Limited should move along with the market. B Limited should move but not equal to market, less than the market movement. C Limited no movement at all. D Limited high volatility. So we can even mark A Limited beta is equal to 1, B Limited less than 1, C Limited 0 beta, D Limited more than 1. How much? Depends. Okay. So using this, we work out the beta factor. Beta factor is equal to standard deviation. SD means standard deviation of the asset means shares. Standard deviation of the shares divided by standard deviation of the market into R means correlation coefficient. All these things you need not work out. I just for your knowledge sake I am giving. The next one is most important. Expected rate of return is equal to risk-free rate of return plus beta factor into RM minus RF. Risk-free rate of return plus beta factor means the volatility factor. This beta factor into RM minus RF. So why are you teaching us again this cost of capital chapter? Yeah, I have done directly this weighted average cost of capital concept. Many students said in the regular class, sir, we forgot what we learnt in intermediate level, so I can't you revise through. That's why I am revising through. All these things are required for solving the problem. Now I request you to solve this example. Maybe I'll read out. Risk-free rate of return is 8%, market rate of return is 12%, beta of ABC, A is equal to 1, B is 0.6, C is 0 and 2 respectively. Same like this. A is equal to 1, B is 0.6, C is 0 and D is 2. Calculate KE means cost of equity, that is expected rate of return for each company. Just pause the video, try to work out. It may take about 5 minutes of time for you. Just apply this risk-free rate of return, that is 8%, market rate of return is 12% minus risk-free rate of return, multiply with beta factor 1.6, 0 and 2. Risk-free return and market return is a constant one, only the beta changes depending upon the volatility of shares. solve it on your own first. Hope you solved it. Let us see. A limited beta is 1, B limited beta is 0.6 and C limited 0, D limited 2. When you work out, you get 12%, 10.4%, 8%, 16%. Remember, A limited equal to market risk, that's why 12%. What is market return? 12%. A limited equal to 12%. B limited less than the market risk, 0.6 less than the market risk, that's why less than the market return. C limited 0 factor, 0 beta factor, which means no risk. You will get only risk-free rate of return, 8%. Right? For D limited, high volatility, high risk, so 16% is the expectation. So when volatility is equal to market return. Less than the market volatility, lesser return. No volatility, it's not no return, risk-free return. Okay, for D limited, high volatility, high risk, high returns. That is what we expect. Actually, actual returns may be different. But this is what we get. Or we expect. Okay, so just copy this, then we will proceed. So we understood how to calculate cost of capital. Okay, or cost of capital using this capital asset pricing model also. Let us come back to this problem again. You have already gone through. Only thing is that we are not given weighted average cost of capital. Cost of debt 9% is given. How to work out cost of debt? I into 1 minus T. So 9 into 1 minus 0.35. 10 into 1 minus 0.35. 9 into 1 minus 0.35, 10 into 1 minus 0.35. Cost of equity is directly given. Cost of equity is directly given to us. So just go through. First, we have to work out NOPAT. I am not solving this because already solution is there. Okay. PBT, profit before tax is there. Add interest, you will get EBIT. We are not given any details about non-operating expenses, non-operating incomes. So earnings before tax, add interest, you get EBIT. Less tax at the rate of 35%. Okay, we get NOPAT. There is a typing error, I hope. Hope somebody named PC has prepared this material. Okay, this is EBIT minus tax. EBIT minus tax will give us what? NOPAT. Okay. So capital employed includes shareholders funds plus long-term debt, right? Shareholders funds plus long-term debt. This one. 500, 470 plus 160 like that. Now, how to work out return on capital? 92.3 divided by 500 into 100. 92.3 divided by 500 into 100. This one, 117 divided by 632 into 100. They have solved by the second approach. 117 divided by 632 into 100. We get return on capital employed. This is 18.46%. The other one is how much? 18.52%. Like that, we get return on capital employed. Right? Then we have to work out weighted average cost of capital. Simple. I into 1 minus T. I into 1 minus T. We know what is I? 9 into 1 minus 0.35. Okay, here it is 10 into 1 minus 0.35 into proportionate funds employed. What is proportionate funds employed? Debt is 110 out of 500. You can check this. Okay, probably I'll erase and do it. Yeah, I into 1 minus T into proportion of funds employed. What is the proportion of funds employed? 110 out of 500. This is 160 out of 632. So this is the weighted average cost of capital for debt component. For debt component 1.287%, 1.645% for debt component. For equity, we know this percentage is given already. 15% into 390 out of 500 is used. That is a proportion of funds used. 470 divided by 632. That is a proportion of funds used. Okay. So we get, this is the weighted average cost of component for equity. So add both, you get which one? Overall cost of capital. This 12.99% is called as overall cost of capital, otherwise called as weighted average cost of capital. Okay. So this is a weighted average cost of capital, otherwise called as overall cost of capital. 12.99% and 14.34%. So how to work out EVA? Return on capital employed. Okay, 18.46%, 18.51% already we worked out now. 18.46%, 18.52% minus weighted average cost of capital 12.99% and 14.34% we worked out. The difference will give us EVA. EVA is 5.47% and 4.17% on the capital employed. On the capital employed. What is the capital employed? Total capital employed 500 into 5.47%. Don't use the word spread and all. It is nothing but EVA. Okay. So 632 into 4.17%. 632 into 4.17%. This is 500 crores into 5.47%. So wherever there is a higher economic value added, okay, that company will be chosen for investment. That is a safe company to invest. So this is called as EVA. So simple, NOPAT minus weighted average cost of capital will give us, you can work out by the other approach also, you will get the same answer. NOPAT is there, just work out by the other approach, capital employed into weighted average cost of capital, difference will be EVA. Like the first approach that we learned, you can try. Then, so hope you understood EVA, the concept of EVA. Next concept is small and very simple to understand. Next concept is called as market value added. Market value added. What do you mean by market value added? Simple. Market capitalization, nothing but total market value of all the shares less book value. Book value is nothing but net worth. Otherwise called as balance sheet value. Okay. For example, let us take Reliance Company's market value as 10 lakh crores. If you take balance sheet value, this is the total value of shares traded in the market. 10 lakh crore is the total value of shares traded in the market. Okay. And their balance sheet value, if you work out assets minus liabilities, that is net assets for available for equity shareholders, it may be 4 lakh crores or 6 lakh crores. that is historical cost value. The difference 4 lakh crores is called as market value added. Market value added. But so what is market value added? Simple. Market value of all the shares minus what? Net worth of equity shareholders will give us what? Market value added. So maybe tested for 1 mark, not more than that, or it can be tested in theory also. So when market value is more, it tells that the company has a good fortune or future, or the company's earning capacity is more, quality of the management is good. Okay, it's able to get more market, more growth in the future. Simple. Why are you paying more than the book value? Because you are anticipating that the company will earn more, it will grow more, it will accumulate more wealth. Based on the future expectation only, we buy the shares. Okay. See, if you look at, I'll tell you certain companies. See, this is a case of Reliance Industry. Okay. If you take certain companies like BHEL, Bharat Electricals Limited, if you look at book value per share, it comes to somewhere about 80 rupees. Book value is 80 rupees per share. If you look at market value, it is only 40 rupees, 50 rupees like that. Why? Because it is supplying the product to the government, and it is having a limited earning capacity, or with assets they earn very less. What is the use of the asset when it is giving you lesser economic benefits? Okay, so that's why the book value of the share is 80, market value is like 50. Okay, if you think that okay, the shares are traded below the book value, let me to buy. I bought some shares, okay, in 2008 for somewhere around 45 rupees or 50 rupees. I hope I purchased it, and I was holding it for about more than 15 years. And after the corona effect, the share price came to 23 rupees, 24 rupees. Okay, because I was thinking that it's a good company, Navratna, it will earn me good profits. But after holding it for many years, the share price remained the same. Because while valuing the shares, I thought, okay, book value is 80 and market value is only 40. I'm just paying 50%, but it became 30% later on. Okay, so but whereas I found the other person who's valuing Reliance was 1.2 times of the book value at the time, or 1.5 times I would say. When they purchased, the market value increased, kept on increased. So then I understood, okay, valuation is based on future. Okay, so probably a good loss to learn the concept and teach you all. So this is market value added. Okay, so let us go to the next question. They ask you to explain theory. EVA is connected with market value. Simple. When EVA is positive, market value will be positive. When EVA is negative, you cannot expect market value to be negative. That you can learn it. And we are given sales, cost of goods sold, gross profit, expense are given, general office administration, selling and distribution, all those things are given. This is EBIT minus interest, EBT is given, tax is given, profit after tax is given. So simple. For us, we will take EBIT, this operating profit before tax, minus tax. EBIT minus tax will give us what? NOPAT. Okay. Then we are given shareholders funds. All those things are given. We are given fixed assets, current assets, all those things. So how to find out capital employed? You can go with liability route. You can add up all these things. Sorry. Equity, share capital, reserves and surplus, long-term borrowings, all those things you can just add up. I hope they have given the total. This 2 lakh 40 plus 1 lakh 60 is 4 lakhs. Long-term borrowings are 2 lakh 40. So 4 lakh plus 2 lakh 40. That method you can apply. Or total of assets minus liabilities. 8 lakhs minus all this 1 lakh 60, 1 lakh 60. You can get capital employed. So either capital plus resource route you can take, or assets minus liabilities route you can take. Yeah, they would have done the same thing. Okay. EBIT minus tax will give us NOPAT. Equity, share capital, reserves and loans will give us what? Operating capital. Return on operating capital 1 lakh 71,600 divided by 6 lakhs 40,000 into 100 will give us 26.81. This is the return on capital employed, ROCE. Then cost of debt, yeah, it's given cost of debt, how much percentage? Where is the information? Expectation of the shareholders is 12%, which means cost of equity is 12%. Cost of equity is 12%. Cost of debt, we can work out. 2,40,000 is the debt for which interest how much was paid? 36,000 was paid. So we can work out interest. 36,000 is interest for 2,40,000. 36,000 is the interest for 2,40,000. Okay. So this is what? Interest divided by debt into 1 minus T, 3.38%. 3.38%. Equity 12% on 6 lakhs 40. 12% on 6 lakhs 40 into the thing, you get 7.5%. I hope they have done a small mistake or conceptual error. Okay, 36,000 divided by 2,40,000 into 100. It will give us cost of into 1 minus T. One minus tax rate 0.4. This will give us KD, and the cost of equity we know 12%. So what is KD? It will give us 15% into 1 minus 0.4. 36,000 divided by 2,40,000 into 100 will give us 15% into 1 minus 0.4. So it will give us 9%, I hope. KD after tax is 9%. This into proportionate funds employed. What is the proportionate funds employed? 2,40,000 out of 6,40,000. This will give 3.38%. First work out KD after tax, that is 9% into proportionate funds employed, 2,40,000 out of 6,40,000. KE 12% into what is the proportion of funds employed? What is the proportion of funds employed? This 2,40,000 plus 1,60,000. 4 lakhs divided by 6,40,000. I hope they have done directly. It will give us 7.5%. It will give us 7.5%. So 9% into 2,40,000 by 6,40,000, proportionate cost of debt. 12% into 4 lakhs by 6,40,000, 7.5%. So add both, you get weighted average cost of capital 10.88%. 10.88%. So ROCC minus weighted average cost of capital into the capital employed gives us which one? I hope there is a rounding of error. It should be dot. Okay. So this gives us what? EVA. That's a positive EVA because you are getting a positive yield. Positive EVA will be there. You can even check the next problem, question number 47. You can go through it. I did not explain, you can go through it. I request you to go through this particular problem on your own. Just simple, NOPAT you have to work out. Okay, then you have to work out capital employed, then calculate return on capital employed, then difference can be taken as what? EVA. Okay. So we have, this is a last problem I hope in your study material. After this there is no problem. It is only valuation of liabilities. That's a theoretical one. So hope you understood two approaches. One approach is go with profit method. NOPAT minus weighted average cost of capital will give us EVA, or work out the percentage of ROCE minus cost of capital percentage into capital invested or operating capital invested will give us what? EVA. We have solved the problem by both the methods and got it. Now coming to your material, Bharadwaj material, okay. There are how many problems? Seventeen problems are there. All these are for your homework. Very good. All these are for your homework. For all the problems, what you have to work out is NOPAT, capital employed, weighted average cost of capital. Three components you have to work out. NOPAT, weighted average cost of capital, capital employed. Either of the methods you can follow. Okay. Try to do this as a homework before you open the next lecture. Next lecture will contain the solution. So don't directly go to the next lecture and open it. Okay, and just keep copying the solution. Please try to work out these all the problems on your own. If you are stuck, no problem. You can watch the next lecture, but you won't get stuck in all the 17 thing. Simple. If you are not understanding the second problem, probably leave about 10-20 lines of gap and go to the next problem like that. Or if you are having a trouble in this question, leave 10-15 lines of gap and go to the next question like that. Please take a proper notebook and solve it. Okay. Don't keep your notebook blank and directly open the next lecture. Okay. Please try to work out on your own all the 17 things. You can just practice, or it is like a test for you. Okay. I am not going to keep any test on this particular chapter. Okay. These 17 problems are like test for you, and solution is going to be there in the video form. Like that you can take it. Okay. Have a great day. Complete it. Probably in 1 day time you can complete it. Don't take about a week time. Just complete it in 1 day. Okay. Just open the next lecture after this particular thing. Have a great day. Yeah, before that, this chapter EVA can be tested for about 5 marks. Maximum 5 marks from this area. Minimum 3 marks like that. It can be tested in MCQ also. The problem is like first question. Don't expect the CMA final level question to be for 5 marks, 6 marks like that. It can be tested for 1 mark. And if the question is like with balance sheet, you have to work out various things, then it may be about 4 to 5 marks they can test this. So one of the good examination oriented concept. Okay, please learn it and complete all the 17 questions. Then open the next lecture.